Hollenhorst. Andrew, you've been at June. These other guys are catching up with you, right? How long have you had this prediction?
So we've had this prediction for some time, and basically what we thought would happen is what's transpired with the data, where we had a little period where core inflation looked cooler, where some of the activity data was coming in a little bit softer, and now we see the data that's come out over the last 2 weeks. It started with that strong jobs report, retail sales that's telling you activity is okay, and most importantly, core inflation still coming in strong. We see it in CPI. We see it in the producer prices also, PPI.
So you're not changing the forecast, though, to include a 50 in there, are you, despite some chatter around that?
There's been some talk about 50. I think looking at the data today, you could go back to that last meeting in February and say maybe it should have been a 50, but you can't go back and do that. They did slow down to 25 basis points. I think there's a pretty strong feeling across the committee that they're trying to find where that right terminal rate is. And as they're searching for that terminal rate, they want to move at a little bit of a slower pace. So the 25 basis point pace, I think, is going to stay for now. If we had a big reacceleration in inflation, maybe we could get a 50 basis point hike again. But I think that's relatively unlikely. March is going to be 25.
I mean, one reason the market has been resilient in the face of rising expectations for now a June hike starting to get priced in is that it looks increasingly likely that the soft landing scenario plays out. You know, where the economy is in better shape at the end of all this.
So I think we just want to be really careful in distinguishing between a soft landing and a landing that happens later and is maybe even a little bit harder. So what we see in the data now is a U.S. economy that's still overheated, that's still producing inflationary pressure. And that's good news for activity in the short term. We're hiring a lot of workers. The economy is still growing. Services consumption has been strong. That's all good news. The challenge for the Fed is that with all that demand out there, all that spending power, inflation stays high. And does the Fed eventually need to move even more aggressively and push even harder on the economy?
So the risk to your forecast now is more hikes.
More hikes.
Not less.
Yeah, I think if activity holds up, if core inflation stays around where it's been, or maybe even picks up, and it could with how tight the labor market is, you could actually see the Fed hiking beyond the 5% range. You could start to think about the 6% range. I think that's still not the base case, not the most likely case, but that's the risk.
The other thing all of economists are doing are pushing out their recession forecast to later. Is that something you've done?
Right. So we haven't actually moved ours. We've had ours in the second half of 2023. We think we might still get there in the second half of 2023. But to your point on the data over the last couple of weeks, it's not there in the data. So we'll see. That could be pushing out.
But you think it's coming, no matter what, because of all the tightening?
We think it's coming. I think if you look at the historical record, if you look at the tightening that the Fed's put in, the historical experience is to bring inflation down.